Hello everyone, this is Royston over here. The first quarter 2024 earnings have just came to an end, and JP Morgan basically did a summary in terms of the 5 biggest takeaway from this earnings season. And I thought it would be interesting to have a quick look as to what are some of these takeaways and how we can actually be generating stock ideas from them. So the very first one is that profits are on top, and that is basically the reason why the S&P 500, or in fact the US market, is showing strength despite the talks of potential recession, spending power being crimped because of persistently high interest rates. Consumers are actually tapering back on their spending, but what we are seeing on the company front is that profits are up. And the fact is that there's a lot of mention in terms of AI and machine learning, which is not very surprising. But in terms of the talks of inflation, it has actually dropped off quite a fair bit. The number of mentions by companies on the term inflation have actually dropped quite a fair bit from 2022 level to 2024. And same thing with regards to economic slowdown. Mentions have actually dropped quite a fair bit. The focus is now on AI and machine learning. And I think this chart is also pretty interesting in terms of where earnings might be, expectation moving forward this year as well as into 2025. And it's interesting to see that for the rest of this year, or at least the entire 2024, it will still be led by the Magnificent 7, which is expected to grow its earnings by 28%. But that ratio is expected to actually come down to about 17% in 2025. Whereas for the remaining 493 companies, this year they are looking to grow at 7%, more moderate as compared to the Magnificent 7. But in 2025, that's where there's going to be substantial earnings growth. Double-digit earnings growth for the remaining 493 companies. And overall on the S&P 500, this year we are looking at 11% growth, going into 14% next year. And for the mid-cap, next year's earnings performance is going to be a lot stronger. So you can see why the stock market is actually still so bullish. Market is at an all-time high because that is driven by earnings expectation. And it does seem like earnings is panning out. And I guess the only reason why earnings performance is so strong is largely because of operational improvement in the form of adoption of AI, helping margins, etc. That could be one of the key reasons why earnings across the entire S&P 500 or US market per se has been so resilient despite all the concerns that we have been seeing this few years. Now, the second key takeaway is that consumer is getting picky. So we can see that things are not all that rosy among consumers. They are actually cutting back in terms of spending on luxurious items, looking at finding lower price items, going to Walmart, for example. So this is something which is, I would say, a minor concern at this point of time. But having said that, in terms of selective spending on certain areas, experiences, cruise, airlines, traveling, entertainment companies, they are still seeing very strong demand. So that's one thing that we can be potentially hopeful about, is that despite the fact that consumers are tightening their belt on certain areas, they are still looking to spend on experiences, on vacations, etc. So that's one thing to look at. And for me personally, I believe that companies which are able to consistently pass on higher rising costs to consumers, because the fact that despite consumers tightening their belt, demand for this company's services as well as products remain strong, those are the companies that you can potentially be looking at in terms of resiliency, despite the fact that there could be concerns in terms of consumer spending being crimped moving forward. So that's point number 2, shareholders getting paid. So a lot of companies are cash rich, and what they are doing is that if they are not paying dividends, they are actually looking at aggressive share buybacks. So that is also something quite important to take note of, and some companies like Meta as well as Alphabet have basically greenlit their very first ever dividends payment this quarter, and that actually speaks quite a lot. And actually authorized more stock repurchases. Apple announced a massive 110 billion buyback recently, the biggest in its history and the market. So it does seem to indicate that Apple believes that the share price is significantly undervalued as compared to the other big tech companies. And we can see why, because it really didn't have a very strong AI narrative as compared to the likes of your Meta, Alphabet, Nvidia, etc. So that's something to also take note of, that a lot of companies are returning excess capital to shareholders in the form of dividend payments as well as share buyback. More companies are spending big in terms of capex. I have previously mentioned that there's a lot of capex spending, and one key area that capex is going into is in the arena of AI investments. The likes of your tech behemoth, Amazon, Microsoft, Alphabet, Meta, they are expected to shell out around $200 billion in the next 12 months. And where is this majority of the spending going to be? Data centers. Okay, so there's going to be a lot of data centers spending over the next, I would say, 12 to 24 months, and which might be some of the key beneficiaries. I've actually covered that in my previous videos, so you can actually go and check them out. Okay, data centers play. And last but not least, the last final highlight is that earnings growth is not across board. This quarter, we are seeing stronger performance across the utilities. Utilities have been one of the best performing sector year-to-date 2024. They have been a huge laggard in 2023, but in 2024, they've actually done fantastically well in terms of the share price performance of a lot of utilities play, and that likely is because of the narrative, the AI narrative, that a lot of utilities players will be benefiting from higher electricity generation. So this is something to take a look. Again, I have mentioned about utilities being a laggard previously at the start of the year, and one which can potentially outperform the rest of the other sectors in 2024. And so far, that narrative has actually panned out. What hasn't really panned out is the fact that the three underperformed sectors, which are the materials, energy, and healthcare, have seen their share prices lagging. But there could be potential in particularly one of those sector. Okay, what I'm saying is that there could be one of this potential in one of this sector, and which might it be? I will talk about it very shortly. So what I'm trying to do is that I'm looking to see if I can actually be screening out for certain stocks based on JP Morgan's summary on some of these key highlights, key takeaways from the latest earnings season. And I go over to my StockRover platform, and this is basically what I do. I try to find companies whereby their earnings per share next year is going to be growing at a much faster clip as compared to the general market. So that's the baseline. Next, I'm looking at margins improvement, meaning companies which are able to pass on their costs to consumers despite the relatively high inflationary environment that we have been witnessing over the past, I would say, 1 year, and interest rates are likely to remain high for the foreseeable future. What I'm saying, or what I'm trying to screen out for, are companies that have that historical track record of being able to generate higher operating margins despite this kind of inflationary environment. So I'm taking a look at the past 2 years in terms of operating margins improvement, and my expectation is that operating margins can continue to improve moving forward as well. Next up, I'm looking for stocks with a shareholder yield of more than 3%. So what exactly is shareholder yield? Shareholder yield is basically the combination of dividend yield plus stock buyback yield. So if a company doesn't pay dividends, but it actually buybacks quite a lot of its stocks, it will be reflected in the shareholder yield as well. So certain companies, like for example Meta and Alphabet we just mentioned, just only announced that it's going to start paying dividends this quarter. So it will not have any form of dividend, but they have also been aggressively buying back their shares historically. So that would be reflected in shareholder yield. So what I'm looking out for are companies that are able to generate shareholder yield in excess of 3%. They are cash rich and they are looking to return part of their cash hoard to shareholders, either in the form of dividend payments or in the form of share buyback. So that is positive. Next up, just now we mentioned that a lot of companies are spending on capex. The big blue chip, especially the tech companies, are spending a lot of money to ride on the AI team moving forward. Now, that is good for certain segments which are the beneficiaries of all this capex. I mentioned data centers being one of them. But when it comes to the company's perspective, I need to know that the operating cash that they are generating more than covers for their capex requirement. So that is where we look at free cash flow, which is termed as operating cash flow minus whatever capex requirement that they have. And I require their free cash flow to be more than 0. Okay. And last but not least, I am also looking at a PE differential of less than 0. PE differential means the difference. Maybe you can just take a look at a quick explanation of what the PE differential means. It's the estimated price to earnings ratio for this fiscal year minus the earnings per share growth forecasted for the next fiscal year. So at this point of time, what is price earnings minus the earnings per share growth. So bottom line is that if this figure is negative, the more negative it is, the more undervalued the potential share might be relative to its growth potential. Whereas if this number is positive, and the more positive it is, it could mean overvaluation. So what we want to find is potentially cheaper stocks that the market is still not yet recognizing for its potential. So that's one, and I'm looking for companies that is having a market cap of more than 5 billion. So not too small, the small caps, but at least their market cap is more than 5 billion. So there's actually 19 stock candidates across the major US listings. So that's pretty interesting. Okay, that's pretty interesting. So which are some of the counters? I can actually show you guys that this is basically the list of stocks over here. Okay, this is basically a list of stocks over here, and there's actually one particular counter that really catches my attention, and that is where I'm looking to use the Traders GPS platform to time the entry of this particular stock. So many of these stocks got good medium to long-term potential, but are we ready to pull the trigger at this point of time? That is something that I will be using the Traders GPS platform to assist me on that arena. So that is something which I will be highlighting in the next video on what are some of these particular stocks that might be interesting candidates. So do take a look out for that.